Hello, welcome to Q24 training. My name is Evans and I will be your trainer for this question. This is the BBA April 2023 paper, question 24. I am required to determine the value of N limited using the free cash flow to the farm model. I am told that M limited is currently making a bid for N limited. The following information has been provided to enable you to determine the various prices that N limited can offer the stakeholders of N limited. I'm provided with the P&L for December 2022 and the SFP as at 31st December 2022. I'm given additional information. Currently, N limited has 4 million shares with a market price of 15 shillings per share. And capture my information. This will be my answer. I have the number of shares in N being 4 million. I have the share price in N being 15. I'm also told N limited's the current market value of N limited debt is 24 million. So value of debt in N 24 million. I'm told N limited's financial statement items are expected to grow as follows. I have the revenue growth rate being 10%. I have the EBITDA margin it's going to remain the same. So I'll use the value given in 2022, which will be EBITDA divided by revenue. This should be percentages. I'm also told depreciation or amortization to grow at the same rate as my non-current assets. The depreciation in non-current assets growth rate to be 15%. Interest expense is about 10% of the previous year's long-term debt, which will grow at 20%. Interest expense 10% of the previous year debt. So here it's not necessarily clear whether it will be the interest growing at 20% or the debt growing at 20%, because in the next statement we are told that retention rate is 60% and any balancing figure in the forecast statement of financial position is long-term debt. So I'll use the balancing figure to find my long-term debt. So then I have my retention rate being 60%, and if my retention rate is 60%, my dividend payout rate is 1 minus I've not captured that right. This is my retention rate. Then my dividend payout rate being 1 minus 60%. Then current assets and current liabilities will grow at 10%. So CA and CL growth rates will be 10%. The applicable weighted average cost of capital is 18%. WACC 18%. And assume that the free cash flows from the farm for N limited will grow at 3% in the year 2028. This is my perpetual growth rate of 3%. I can then use these values to forecast my statements. I start with the statement of financial of profit or loss. First, I'll have my years from 2022 to 2027, being 5 years beyond 2022. Then I'll pick my values as provided by the examiner. Maybe before I do that, I can move all my values to the top of my worksheet. So now I can fill in my statements from revenue, I can also pick my SFP just so I can pick all of them together. Then I can pick the 2022 values. All the way to the end. Then finally I can pick the formatting. Borrow formatting from the examiner and place it appropriately. That since formatting will affect the next 5 years. So I can remove the unnecessary zeros now and start filling in my value. This will be the statement of financial position. You can now start forecasting revenue at a growth rate of 10% to equal the previous year multiplied by 1 plus my growth rate of 10%, which I lock and copy this across. Then I don't have my cost of sales, but I have my EBITDA margin, which was 20%, which I will lock off my revenue. To find the cost of sales as a negative value, I'll have my EBITDA minus the revenue. So this should have been, we should have locked the EBITDA margin and copied it across. Then my depreciation has a growth rate equal the previous year multiplied by 1 plus a growth rate of 15%, which I lock and copy across. EBIT will be the sum from the previous total, copied across. Interest will be 10% of the previous year's debt, so this would be equal minus 10%, which I lock, multiplied by the previous year debt, which is 24,000 in 2022. This I can copy across in as much as I don't have my other values. When I fill this in, my values here will also populate. My earnings before tax will be the sum of the two from the previous total. Then my tax is given at 30%, so we will capture that. Tax 30%, so this will be equal minus 30%, which I lock, multiplied by my earnings before tax. Net income will be the sum from the previous total. Dividends, I have a dividend payout rate, which will be equal minus 40%, which I lock, and multiply by net income. My retained profit will be the sum from the previous total. My retained profit brought forward will be the retained profit carried forward in the previous year. And then finally, my retained profit carried forward will be the retained profit for the year plus the retained profit brought forward. So the sum from this, which I can copy across. Then I have my non-current assets. They had a growth rate, so they should remain 18,000 shillings. I had a growth rate for my non-current assets equal the previous year multiplied by 1 plus a growth rate of 15%, which I lock. Current assets also had a growth rate equal the previous year multiplied by 1 plus the growth rate, which is 10%, which you lock. Then this will be the sum of the two values. The ordinary share capital, unless anything changes, will ordinarily remain to be the same. We have not been told that any new capital was issued. My retained earnings will be the value from the previous year plus the retained profits for this year. So that my total equity will be the sum of the two. My long-term debt, I have been told this will be the balancing figure. I have a gross rate for current liabilities equal the previous year multiplied by 1 plus my growth rate of 10%, which I lock. My total liabilities will be the sum of long-term debt and current liabilities, in as much as I don't have long-term debt yet. Then the total capital and liabilities will be the sum of my total equity and total liabilities. You notice that our statement is not balanced, and that's because we don't have our long-term debt. So my statement should balance by the same values I have for my total assets. So to find my long-term debt, I'll have my total assets minus the total equity, minus the total equity minus the current liability. And the difference will make my values balance. And in so doing, I also now have my amount of interest calculated as 10% of the previous year's debt. But this is just a forecast. I now have to present my free cash flow to the firm. Cash flow to the firm. Here I'll also need my years, but this time only from 2023 because I want to use the forecasted values. So 2023, 2027, and go to formatting. Here now, I'd like to start with my earnings. My earnings before interest and tax. From the year 2023. Then from there, I will less tax on EBIT. Tax goes at a rate of 30%, so equal minus 30% of my EBIT, which gives me an operating profit should have locked my tax rate, so that I can copy this across. My operating profit will be the sum of these two. From there, I need to add back my non-cash items, which would ordinarily include depreciation. So this would be depreciation added back. And because they were negative values and have equal minus, then the value is in 23. Beyond this, I also want to account for capex in the form of this. Capex would be the difference in my assets. If my assets were this value 1 year and a different value in the next year, the difference in value is my amount of capital expenditure. So the capex in 2023 will be the closing value of assets in 2023 minus the closing value of assets in 2020. Copy the plots. Then I can now account for my working capital changes. Working capital ordinarily involves my receivables, payables, and my inventory. But this time I only have current assets and current liabilities. So for my current assets, in the year 2023, I have current assets of 26,400, and in the previous year I had 24,000, meaning a lot more people owe me money. Assuming these were receivables, a lot more people owe me money. But if these were inventories, I have spent an amount of money to increase those inventories. So this will be a cash outflow given as the lower value minus the higher value. And for my payables, I began my year with payables of 20 and then ended up with payables of 22, meaning I have more of people's money, meaning that's a cash inflow. From there, I will call this my net cash flows. Because I'm yet to calculate what's called the terminal value to give me my free cash flows to the fund. So this would be the sum from the previous subtotal can copy this across. Now my terminal value is usually given as the final cash flow multiplied by 1 plus G divided by WACC minus G. So this will be this final year cash flow multiplied by 1 plus the perpetual growth rate of 3% divided by 18% minus 3% divided by 18% minus 3%. This gives me a terminal value of 268,258, and I can find the sum of these two previous values and copy that across. From here, I can find the value of N as this cash flows discounted by the WACC. To do that, I'll use the NPV function. My rate will be 18%, which is my weighted average cost of capital, and my values will be my free cash flow to the firm from 2023 to 2027. This gives me a value of N of 212,151, but this is the value of the firm. If I want the value of equity in N, I'll take the value of N minus the value of debt. So this was 212 minus my debt was what? 24 million. So this will be this divided by 1,000. And so the value of the equity in N is 188,151. We can compare this with the market value of equity in N, which would be my 4 million shares multiplied by 15, and they divide by 1,000 to bring it to scale. And so the market is grossly undervaluing my investment in N. And so I should buy this investment because it is grossly undervalued. And that will have been the answer for that question. Thank you very much. I'll see you in the next one.